When I first started investing, I made so many beginner investing mistakes, including relying on stock picks from friends, hearing about people talking about different stocks and then just buying into them straight away. And because I made all of these beginner mistakes, I lost quite a bit of money from that. So in this video, I really wanted to break down the different things that I've learned on how to really do your proper due diligence and research into a company before you invest in it. Hopefully you guys can avoid those same costly mistakes that I made when I was a beginner investor as well. And make sure that you do stay till the end of the video because I'm going to be going through when to buy and when to sell shares. And by the way, if you do want to learn more about how to invest in different types of shares, I really do recommend Brandon from Aussie Wealth Creation and his investing courses on Profitful. I personally have learned so many things from doing these courses myself. So if you want to learn more about this and go into more detail about how to invest in shares and research different companies, I'll put a link in the description below so you can check it out. And with that said, let's get into the video. So the first step is to really understand the business. So what I mean by this is picking a business which you really actually understand and is within your circle of competence. I only really invest in businesses now that I'm actually a customer of, or I really understand the inner workings of the business quite intimately. I've made so many mistakes by investing in companies I really just didn't understand because let's just say they're in the healthcare industry, something that I'm quite far removed from in my day-to-day jobs. By investing in these shares, I have made quite a few losses on companies that I just really don't understand. So I think that that's the first step. Make sure that you always buy into companies that you actually really understand. But it's not just about understanding the business and being a customer of this business. You actually need to do your due diligence and really understand the inner workings of the company and how they actually make money. The first step is to look into the annual report of the business and the 10K. These are reports which are publicly available because once you're listed on the stock exchange, you do have to disclose all of this information to the public. And the 10K is sort of like an annual report, but it goes into a lot more detail. So that's why it's really important that you do look at both the annual report and also the 10K. A 10K is an annual report which is filled out by all public companies and publicly discloses their financial information. To find a 10K, it's pretty easy to find. Basically, all you'll need to do is type in the name of the company and then 10K next to it on Google. So as an example, let's use Apple and their 10K report. We select annual filing and the last one is in October 2019. I know it might look pretty daunting the first time you look into one of these 10K reports, but I promise you it's not as scary as it looks. Simply go into the table of contents and then skip to part 1, the business. Here you'll be able to see a brief description about the business and the different ways that they make money. At Apple, they make wearable technology and different consumer technology devices. For example, iPhones, laptops, smartwatches, AirPods, tablets, the list goes on. So once you've read this section of the report, you have a bit more of an understanding of the business and how they make money. And the next step is to start analyzing the financials of the company. By the way, what companies are on your wish list? Let me know in the comments. For this step, you need to head to part 2. Under products and services performance, you'll be able to see the exact split of revenue from all of Apple's products from the past 3 years. And we can see here that most of Apple's revenue is actually coming from iPhone sales at over 50%. And you can also see that the revenue of iPhone sales has actually decreased by 14% from 2018 to 2019. And you can see this note here that that was primarily due to lower units of iPhones being sold at that time. And you can also see that wearable technology has increased by 41% in the same period. So we can see that a lot more people are buying wearable technology and wearable devices. So it'll be so interesting to see what happens in the future, perhaps with their new Apple glasses coming out. Are you guys thinking of getting Apple glasses in the future, and what are your thoughts on them? Let me know in the comments. So now we know where the revenue is coming from. Now it's time to actually start analyzing these numbers. And by the way, if you're enjoying this video so far, please make sure you give this video a like. It really does help out my channel and helps me understand what you guys like. And if you're not already subscribed, please consider subscribing to my channel. I do produce 2 new videos every single week about making money, saving money, and also investing. So if you enjoy content like this, please subscribe. So the next step is to really start to analyze the financials of the company. For this, we head out of the 10K report and we actually jump into our brokerage site. For example, I actually use CMC Markets and it has all of the numbers and the financials listed on that website. You can also check out MSN Money and Yahoo Finance to find these numbers as well. For the financial companies, there are a few key numbers that I look into before investing into a company, and these are revenue. So this is how much money they generated. Operating income. So this measures the amount of profit realized from a business's operations after deducting operating expenses such as wages, depreciation, and costs of goods sold. Net income. This is calculated by income minus the costs of goods sold, expenses, depreciation, amortization, interest, taxes for an accounting period. The next one is operating cash flow. Operating cash flow indicates whether a company can generate sufficient positive cash flow to maintain and grow its operations. And then free cash flow. This is to see what is available for distribution among all the security holders of a corporate entity. So ideally, with all of these numbers, we want them to be positive and also going up year on year. So that indicates that the business is growing. Another metric that I look at is the return on invested capital. And ideally, I like this number to be about over 10% each year. This number helps you understand how well the business is using its cash flow to generate returns. So the next point is the PE ratio, or the price to earnings ratio. You've probably heard about this term a lot, but basically what a PE ratio is the ratio of a company's share price to the company's earnings per share. This ratio is used to see if a company's stock is overvalued or undervalued. Personally, I like to invest in stocks which have been listed for more than 10 years. So this is because I will have a lot more historical data on the stock exchange to really analyze and see if this is a company that I want to invest in. So after looking at these numbers, let's just say they're all in the green. Now it's time to start looking at the competitive advantage of this company. Another reason why I like to look at companies which are already well established is because I want to see if this company has longevity and if it can really survive in the long term. The competitive advantage is also known as the economic moat. An economic moat means that your business has a distinct advantage over the competitors, which will allow this business to be profitable in the long term. This advantage should be something which isn't easy to mimic or copy and should have an effective shield against the competition, which can be really hard to compete with this company. And the next step is to actually have a look into the management team of the company. This one might seem a little bit strange at first, but the reason why I do like to look into the management team of a business is because effectively, when you're a shareholder, you're giving the business money to grow and invest in their business. And the people who are making all of the decisions on behalf of this business are the management team. So you want to ensure that they have the best interests of you and also the company at heart. Having a management team which is really unethical can really also damage the reputation of a company and send the share price plunging. So this is also a very important step to really look into the management team of the company before investing. And the next step is to actually calculate the value of a business before investing in it. There are so many different methods you can use to value a business. The one I personally like is the one by Phil Town, and this one is called the margin of safety. And there actually is a calculator on his website you can use to actually calculate this number for you. I've put a link in the description below, and let me know in the comments if you'd like to see a video on how to calculate the margin of safety price. So basically what the margin of safety price is evaluating a business in order to have a bit of a margin of safety, because we never really know what's going to happen in the future. So that's why it's also important that you do have a bit of room to move just in case the share price does drop. So the margin of safety should be able to give you about a 15% return on investment year on year over a 10-year period, and also allows for a bit of fluctuation and uncertainties in the market. And this is sometimes sometimes referred to as buying $1 of value for 50 cents. This is so that you can be really safe with your investment and also ensure there's a little bit of room to move when it does come to the price that you're buying it at. So now you've done all of your due diligence, now you're ready to buy this share. The next step is to know when to actually buy this share. Personally, I've learned over the years never to buy a share as soon as it just really drops in value because you don't really know when it's going to stop. I always buy when the stock is undervalued and also when the price is going up a little bit after a drop. For this, you can look at the average true range, or ATR. The average true range is a moving average of the share price over a 14-day period. This can give you an indicator on where the share price is going and how the market is moving and how volatile the market is at that particular point in time. It doesn't just have to be a 14-day average, it can be 10 days, it can be 30 days, it really just depends on what you're looking for, but the average is 14 days. This can help you get an overview on whether the share price is going up or if it's going down over a moving period. And the final step is to know when to sell your shares, and this can be arguably the hardest part when it does come to investing. There is a really great quote from Warren Buffett which I just love when it comes to this, and it's that only to buy into something that you'd be happy to hold for 10 years or more. So personally, as a long-term investor, I try not to sell my shares unless they have a really great profit. I do like to keep my shares for over 10 years or so because I am a long-term investor. In conclusion, I know that there are so many steps in this video, and investing in a business, it's really not an easy thing to do. However, I do think that this research is so important to do at the beginning because you'll just feel so much better about your investments once you do start to invest in it, and you'll just sleep better at night knowing that you have done your due diligence into your shares. You are investing your hard-earned money at the end of the day, so you do want to make sure that you're making a good return on investment from it. The reason why I go into so much detail before I am investing in a company is because I have made so many beginner's mistakes in the past. I've lost quite a bit of money when it came to speculating on the price of cryptocurrency and other shares that I don't understand. This is the reason why I always do my due diligence and really research a share before I buy into it, because I just don't want to make those mistakes again. So let me know in the comments, how do you research a company before you buy into it? Let me know. And thank you so much for watching this video. I hope you enjoyed it and I hope you found it useful. If you did enjoy this video, please give this video a like. It really helps out my YouTube channel and helps me understand what you guys like. Thank you so much for watching this video. I'll see you later. Bye.